Good morning and welcome to this week's edition of Winston's Weekly, covering all things property. I'm Manny Anton, your host for today's property chat. Winston, as always, thank you for your time.
It's a pleasure.
All right, let's start with the US as usual. Now it's been an interesting week. Quite a bit of data around, and again, rates have been swinging around a little bit. When, quite frankly, rates have been going north, so that's really where it's been heading. But the US real estate sector has again seen some decent swings as well during the week, as a result of that, what's going on there on that inflation and rate front. So most of the data this week is basically showing that the US economy remains very robust. In fact, overnight we had some jobless data, for example, that again, was suggesting, hey, things are still looking pretty good from a US economic perspective. Now, obviously, markets are thinking, well, that's going to make it pretty tough for the Fed in terms of their interest rate policy. And in fact, the Fed chair came out during the week as well and made some comments about, perhaps having to hold rates at current levels for a little bit longer. What are your thoughts around that?
Well, obviously the data that's come out does suggest and support a much stronger US economy than a lot of people would have hoped for. We don't want to see a recession, which is probably off the cards now given how strong the economy is going. But given that it is very strong, it does put pressure on the Fed not to cut rates early. So it's really about the timing issue, and I think people are getting a little bit disappointed with the fact that we haven't seen rate cuts yet, and they're now likely to be pushed out. Yeah. The bond market is really what is being focused on, and the 10-year yields have gone above 4.5% in the US. They are edging closer to the 5% level, which is a bit of a worry. Whether they get there or not is another matter. If there's some more strong economic news coming out, we may see that. But that's likely to be a short-term impact rather than anything else. And it's a similar situation here in Australia. The data that's come out here, the employment data that came out during the week, does suggest that the economy is still cranking along. And so the prospects for rate cuts in Australia as well are being pushed out.
Okay, well let's move on to the domestic markets. Domestic property. Now, there's been some interesting discussion I've noticed this week about some of the trends we're seeing in the office sector. It's been a little bit in the press. I think there's been some surveys about vacancy rates across the office space. Now, a recent analysis on CBD office has shown that there's a growing trend here that sees, there's a growing gap in vacancy numbers emerging between Grade A and Grade B office.
Yeah.
What's happening there? I mean, what's driving that? What's the outcome of that ultimately?
Well, given the amount of vacancies that has been around for a while, tenants now have a bit of a choice as to where they want to move to. And it sort of helps their bottom line in a way, because less people are coming into the office, so they need less space, but they want to improve the facilities and the offerings for their people. So they're moving up in terms of quality. They may be paying per square metre the same or probably a higher rate, but they're actually leasing smaller spaces. Right. So they come out net flat rather than actually spending more money to improve their position. And that's something that the sector, particularly the office managers and so on, are sort of focusing on, offering better quality office space, even though it might be smaller in terms of needs, but at least that's where the demand is. And conversely, what will happen is that the lesser quality assets are the ones that are going to suffer going forward.
What happens to those assets?
Well, a lot of them, in the past, they used to be either converted into some other use, like residential or hotel or so whatever. Repurposed. Right. Or in some cases, it might be a case of, depending on how old they are, of completely pulling them down and rebuilding something new. But that's a fairly risky thing to take on at this point in time. But I'm sure as time goes by, some of those things will eventuate.
How would you play that particular thematic, that movement of A versus B? How would you play that in the listed space?
Well, you want to be invested in those REITs that do have the quality assets, the A grade. Now, realistically, not every building that an owner owns is A grade, and so they're also working through their portfolios in terms of curating them to have a higher percentage of the better quality, the premium, the A grade buildings, and sort of offloading some of the lesser quality properties if they can.
Okay, great. Let's move on to M&A, BWP Newmark. What's the latest on acceptances on that front? Have they got their 90% yet or not?
No, they haven't got their 90% yet. The last figure I saw, which was yesterday, they're in the low 80s, 82, 83%. So they've still got another 7% or so to go to get to the 90. But they have extended the time frame to not this Friday, but the following Friday of next week. But it's been slow going, which is quite interesting. I know they've been ringing every investor that is still out there that hasn't made up their mind to try and get them to sign up. So that's I think that's what the process they're in at the moment.
Okay, and looking forward to next week. Anything material that we need to be focused on from a property perspective, or is it?
We're in that sort of grey area at the moment in terms of either news or situations that will impact. So we're left to the vagaries of what happens with the bonds and what happens with CPI numbers as they come out. There's no results due. There's no updates, no quarterly updates. All that's happened in the past. So it's really a matter of working your way through at the moment. Interestingly, last month the REIT sector was up a strong 9%. This month so far it's down about 8%.
Yeah.
And that's the impact of what's happening with rates and concerns about pushing out the time frame of rate cuts.
Yeah, and we've seen that, as I mentioned earlier, we've seen some pretty decent swings in US real estate as well. So
yeah. One thing that is, perhaps I should note, is that in the US there was a report came out that basically said that the demand for industrial space has somewhat come off the boil. Now it's not it hasn't come off a hell of a lot, but it was enough to. Prologis is the largest listed industrial entity in the US, and that got knocked about quite a bit. And it did have a slight impact on Goodman's here, but Goodman's is still sort of powering along on the basis of the fact that they're concentrating now on data centres, which are very, very big demand, and they have a lot of opportunities in that space.
All right. Well, Winston, thank you for your time and insights today, as always.
It's a pleasure.
And we will be back with another edition of Winston's Weekly after the Anzac Day weekend. So have a great day and have a great weekend.